Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Snelson, attorney at Vinson and Elkins. We also have Harvey, global head of sustainability at Nasdaq. It's great to see you both. Welcome to Trade Talks. And Caitlin, I'd like to start with you. We hear about these different terms, sustainable finance, ESG, and so forth. What exactly is sustainable finance?
Yeah, first of all, Jill, thanks so much for having me here today to chat with you. So sustainable finance really is just a term to describe capital deployment that's motivated by or linked to ESG criteria. Now, as you mentioned, that term is being used more broadly to talk about sustainable debt. And when we talk about what sustainable debt finance is, really talking about two different types of instruments. So one is a use of proceeds types instruments where your green bonds and green loans, social bonds, sustainability bonds, those sit, as well as sustainability linked loans and bonds, which are both in the market right now.
Evan, why are firms committing money to these projects?
For a few reasons, Jill. First of all, I think they're trying to create more sustainable outcomes. That's why use of proceeds is such an important distinction in some of these instruments. They want to reduce carbon emissions. They want to reduce destabilizing trends like poverty and disease and hunger. There's a lot of demand from clients and others right now to have these instruments in the market. I mean, according to Bloomberg, this is a $730 billion market last year, just sustainable debt. And then last but not least, in addition to all these sort of positive outcomes, they want to make money. And they are seeing analysis lately that starts to suggest that there is a real money to be made in this space. Climate change, other ESG issues are sort of determinants of future value and future risk. So it's really an essential part of market price and long-term valuation exercise.
And Evan, it's a relatively newer space, certainly in the United States. What kind of innovation are you seeing?
Well, we're seeing innovations on the instrumentation side. We're also seeing innovations on the market side. So you might have heard Nasdaq just took a majority stake in Puro.earth, which is it's like a B2B marketplace for carbon removal technologies, really looking at interesting and innovative ways to pull carbon from the atmosphere rather than just offset usage. We have a sustainable bond network, the Nasdaq Sustainable Bond Network, that creates issuers and investors on bond issues in specific sustainable areas like SDGs. So if you have an investment that is targeted for a particular SDG, a UN Sustainable Development Goal, you can find a bond that matches your interest. And then we're just also finding this theory spread out into all kinds of other instruments. So we have net zero financing, we have social loans, social bond principles. This move to codify and standardize this ESG instrumentation is happening all across the spectrum.
Caitlin, we can understand why there's interest in the capital market space. Why would law firms like Vinson and Elkins be interested in the sustainable space?
Right, and so really, these instruments and the debt instruments in particular, they look very much like loans and bonds that are already be done in the market. They just have added features or added qualities. And so the transactional aspects with any debt issuance are still in play. And of course, lawyers are very involved in that. Another interesting kind of aspect is that this, ESG really cuts across, not just financial markets, but governance issues. And so we're really involved with our clients, at all stages as they're thinking about their internal policies, their strategies, and as well as putting those in place and having them ready so that they can be in a position to issue sustainable debt.
And Caitlin, BNEF recently announced a new record in sustainable debt. Why is this timely? Why is the industry interested in this?
Yeah, I think as Evan touched on, proven returns and investor demand, and this is really the debt market's answer for ESG investment. It's growing very fast. I think a more interesting question is, when was the last time a record wasn't set or announced? And it's exciting to see in the market because everyone is trying to catch up with the amount and volume of debt being issued to address concerns, greenwashing and disclosure concerns, verification frameworks, et cetera.
And Caitlin, in your conversations with clients, what are they most concerned about?
Right now, it's how do I get in the market, and how can I participate? I think we see Amazon and Starbucks and big names, JP Morgan and HSBC and the big banks participating. And really, I see middle market clients and regional banks saying, we want in, and how do we get there when we don't have the same large infrastructure?
Evan, is there a one-size-fits-all answer and reporting standards as these financial instruments evolve?
No, I don't think so. Much like you've seen on the corporate reporting side, if you believe in the materiality standard, which we do, that says that firms sort of self-determine material issues for their business. You can't say that a sneaker manufacturer and a chemical producer have the same exact priorities when it comes to even environmental goals. So that's an inhibitor on the one-size-fits-all standard. Right now, there's a lack of standardization. There's no real regulated gold standard across the world, which makes this difficult. We're seeing the emergence of certain pieces of this, Climate Bonds Initiative and other sort of standard setters. There's very little validation and auditing of some of these labels. A lot of greenwashing complaints come from the lack of scrutiny when these instruments are created. And in some ways, I think the most important point of this, Jill, is that these are still moving targets. Carbon reduction, water stress, green energy, poverty, disease. Those are all things that are very difficult to design specific financial instruments to address. And as long as we don't have an understanding of the scope of the problem and who has to participate in the solution, this is all be sort of a makeshift effort.
Yeah, and I think, Evan, just to piggyback on that, if I might, everyone's expecting to see continued growth in the sustainability linked instrument, whether it's a bond or a loan. And the idea behind that is that it's meant to enhance a company's existing ESG strategy and be another tool in the tool belt. And so inherently, that instrument has to be specific to each company. It doesn't accomplish the same goals if we're trying to plug and play for any given company in this space.
Yeah.
So, Evan, it sounds like at the end of the day, it's investors, whether they're looking on the debt side, equity side, cash infusion, that's really going to be the determinant, right?
Yes, and they've been the big pushers on the equity and transparency side too. So the more interest they have and the more they can demonstrate a material return and material impact of some of these instruments, the more influence they have. And I think that they're the ones who are really encouraging and pushing companies to move. Now, there are other stakeholders that are involved, company employees and supply chain and other parts of the spectrum that actually drive change, but investors hold the biggest card.
All right. Evan, Caitlin, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks.